Hi everyone, today I'm going to show you why everyone who can afford a cash value life insurance policy should get one using what I like to call the tax control triangle. The important word here is control. This video was made and presented by thesilvershark.com. So, when you retire, it's going to be three pockets from which you're going to draw money from. We'll start at number 3, which contains individual retirement accounts, 401ks, 403bs, and simplified employee pensions. The way these investments are taxed is before tax money goes in, the money grows tax deferred, but when you cash out, the money gets taxed as ordinary income. Another drawback with these investments is that you get taxed if you pull them out before you're 59 and a half years old, and you have to start pulling them out before you're 70 and a half years old. The second pocket includes investments like stocks, mutual funds, ETFs, CDs, and savings accounts. These investments are purchased with after-tax dollars, and when you pull them out, you have to pay capital gains taxes. They're long-term and short-term capital gains taxes. You also have a little leakage when you get dividends. You get 1099 for those dividends that you get. Finally, in pocket 1, there are investments like the Roth IRA, which I recommend everyone to get if you qualify. There's municipal bonds, there's cash value life insurance, and 529s, which are education investment vehicles. The way these investments work is you put in after-tax dollars, they grow tax deferred, and you get to pull it out tax-free. So I always like to ask my clients, which of these is the best place to put your money? In my opinion, there isn't a best option. They all have their advantages and disadvantages. So I tell people to diversify their assets. Now let's look at two scenarios. Scenario 1 is what a lot of the portfolios of my clients look like when they come to me. They have negligible assets in pockets 1 and 2 and have their money in an IRA or a 401k. So when they pull out this money, they can only get 65% of it, which is $65,000 from $100,000. So again, I tell them they should diversify. Instead of putting all their money in pocket 3, you should put some in the stock market and you should put some in your Roth IRA or a cash value life insurance policy. So if your assets look like this, when you retire, you could effectively pull out 30,000 from pocket 1, since that comes out tax free. From pocket 2, you could pull out 25,000, 25,500 to be technical, at a 15% capital gains tax. And you could pull out 26,000 from your your IRAs or your SEPs based on a 35% tax bracket. You'd pull out 26 from 40. And if you add this all up, you get 81,000, which is obviously a lot better than 65,000. So, let's go back to the triangle. The take home again is to diversify your portfolio. A lot of tell me they can make 25% to 40% a year on the stock market on average. I tell them, I bet you can't. But it doesn't matter because you can't control these taxes, can you? Now, do you think taxes will go up or down in the future? So here's the history of federal income tax in the US according to Wikipedia. As you can see, in the 50s to the 70s, it was very high. Now, we're almost at an all-time low right now, and with the US deficit and social security problems, most economists believe that taxes are going up. I also personally think they're going up. So again, just diversify your portfolio. Don't leave all your money in taxable assets. Most families make too much money to qualify for a Roth IRA. Municipal bonds don't make that much on the rate of return, and a 529 plan can only be used for education planning. So what's left? Cash value life insurance policy. Woohoo! Come get some. So if you're not convinced yet, this was taken from a client of mine who is a conservative investor. Most of his money is in fixed income. And Ibbotson and Morningstar, which is the leading authority on asset allocation, says that if you take 30% of your portfolio, from the fixed income and put it into a cash value life insurance policy, it can do it can both increase your expected return by 0.32% and also decrease your standard deviation or your volatility by 1%. So, although these numbers may look small, over the long run, this could be making you extra few $1 million. So, I can certainly run a Monte Carlo simulation for you and your situation if you give me information. If you have more questions or feedback on how a cash value life insurance policy works or the tax control triangle, just send me your name and your phone number to thesoulofashark@gmail.com and I'd be happy to contact you as soon as possible. And thanks for listening, and remember to like this video and look out for my other videos. Thanks.